Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by United Wholesale Mortgage.
Does your wholesale lender do this for you? Free customizable marketing materials, online loan tracking for your clients, returns your past clients to you, and complimentary client retention campaigns. Don't you think it's about time you found one that does? Partner with United Wholesale Mortgage and receive these benefits and more.
Hi, I'm Barry Habib at MBS Highway, and welcome to Master of the Markets. This is created exclusively for Mortgage News Network. Well, it's finally here. It's Fed Week, and this is probably the most highly anticipated Fed meeting in a very long time. The reason for that is because this is the first time in 9 years that there is really a chance that the Fed will hike rates. It's been quite some time, and there's still quite a bit of debate, so let's break it down, and let's understand maybe what the Fed might be thinking, what they might do, and what the market reaction could be to that, because it's pretty counterintuitive, and I think that this will help you explain it better to your referral sources and to your customers. So first, the Fed has 19 members, but only 10 of them vote, and that rotates. Now, of these 10 voting members, 7 of them are considered to be doves, or very accommodative, perhaps less likely to pull the trigger on a rate hike. Only 2 are considered to be hawkish, more prone towards being conservative and hiking rates, even if it might be a little bit early. And then there's 1 centrist. So as you can see, the bias is already towards keeping rates low, and that's why we've been in this situation where some think that the Fed should have hiked rates a while ago. But we're getting a lot of conflicting reports, and even the Fed members themselves, and especially those who are voting members, have really been disconnected. Some saying, hey, you can really make the case for hiking rates and talking about the growing economy, low unemployment rate, some wage pressure, inflation. And then there's others saying that inflation hasn't met our target. There's others that are saying that forget about hiking rates, we should actually go with more quantitative easing. So they couldn't be more disconnected. So this is going to be a really interesting Fed meeting. It's going to take place Wednesday and Thursday, with the decision coming out Thursday afternoon Eastern Time. But what we'll look forward to is we're going to look forward to the Consumer Price Index report, which is going to come out the day before on Wednesday. I think this is very important because there is a chance that that Consumer Price Index could bump up to where the year-over-year core rate of inflation could be at 2%, and that's going to raise some eyebrows. Now, there is some inflation out there. The labor markets are tight, and people are ponying up for employees. There is some mild inflation out there within the economy, but we are seeing more of it in the service area. So there's inflation out there, and talk to anyone, and when they talk about educational costs or medical costs, they're going to tell you, hey, there's some inflation out there. My bills are not getting cheaper. They're probably going up. So many of us are having a tough time when the Fed said there's zero inflation. But what the Fed's going to be looking at is they're going to be looking at what would the impact be of a Fed rate hike on the overall economy, and there's fears that it may hurt the economic recovery. They might think it's too fragile. I mean, I personally think that the economy could certainly withstand a quarter-point rate hike. Now, our currency would get stronger. That would make it a little bit more difficult for exports, since much of the rest of the world is trying to lower their currency to make it more possible for them to do more exporting. But what I'm really focused on is the impact of Fed action or inaction. So this is the part that I talked about earlier with you, that it could be very counterintuitive. Now, if there is some inflation, and there is some out there, that's the enemy of the bond market. That's the enemy of bond prices. And if you were a bond holder and inflation were higher, well, if you've got a bond, you're just getting a fixed rate return over a long period of time. So the higher rate of inflation, the more it erodes the value of your fixed rate return, because it could buy less and less stuff. The only way you can combat that is by increasing interest rates. And because we've seen some mild inflation, that's why we've seen interest rates go up this year. Remember, back in January, the 10-year Treasury note was at 163. Today, it's at 223. So we're seeing roughly 60 basis points increase in the 10-year Treasury note yield. So interest rates have moved higher even without the Fed doing anything because inflation's moved up and therefore interest rates are trying to keep pace with that. So if we see maybe a little more fear about inflation due to a higher CPI number on Wednesday and the Fed does not act to raise interest rates, so if the Fed does not hike, I think mortgage rates get worse. I think interest rates go higher. I think bond prices go lower. And that's because if the Fed doesn't do anything to curb inflation, the bond market will take matters into its own hands. Now, how about if the Fed does hike rates? Very counterintuitive, but I believe strongly that interest rates will behave well, will act favorably, because the Fed will be taking measures to curb inflation. I think interest rates improve. And this is the counterintuitive point. But you see, we also have historical data. It's been a long time, 9 years since the last Fed rate hike. But in the past, when we start to go back, and doing this as long as I have, been in the industry for 30 years, you've seen some of these cycles where the Fed was hiking rates. And almost always, when the Fed hiked rates, and it was due to stay ahead of inflation and curb inflation, bond prices actually improved. So it's going to be a very exciting week. We'll recap it next week for you. But stay tuned, especially Wednesday morning, 8:30 a.m. Eastern Time, to that CPI number. If it comes in year over year, core CPI, 2%, will raise some eyebrows and almost force the Fed's hand. And if the Fed does not hike rates, in the face of that, look for mortgage rates to get worse. And if the Fed does hike rates, look for mortgage rates to get better. All right, talk to you next week. Bye-bye.
Today's Master of the Markets was brought to you by United Wholesale Mortgage.
This is Mortgage News Network.